Now the part of the show that we have on, I guess, every show, where I discuss three topics, three ideas, perhaps sometimes three events that I believe individual investors should focus on before you make your investment decisions. And the three I have there today, some of them we have regularly on our show, which are corporate earnings. Corporate earnings season continues, kicked off with the big banks, I guess, about a week ago or so. And now we're moving into the tech sector, which is very crucial for growth. So corporate earnings this week and beyond. Number two, or the second point, economic data to watch. And two things I'm focusing on towards the end of this week. I know today is Wednesday, but Thursday and Friday, we have GDP on Thursday out of the US. And Friday, we have the all-important PCE number, personal consumptions and expenditures. This is a number that the Fed focuses on with respect to getting a read on inflation. So those are two data points that are extremely important. And our last point here that I wanted to focus on, perhaps something new that we haven't spoken about, is should investors consider overweighting positions at this time in their portfolio? We always talk about a diversified portfolio, a balanced portfolio, but should investors ever overweight certain positions? I'm going to touch on that as well. So let's get to the first point, which are corporate earnings. Corporate earnings this week, corporate earnings next week. We just had, I think, some key earnings come out. Three I wanted to touch on. First, maybe not as important as the other two, would be GM. I thought I'd bring up GM. It's not a name I talk about all the time, but I was actually surprised to the upside. Even though GM trades at 4-5 times earnings, so very, very cheap, it's a stock that I've said many times, it's a bit of a value trap, or at least it's been a value trap for investors for quite some time. I've owned GM. Stock really didn't go anywhere. In fact, when I owned it for clients, it actually went down. So, it's you buy once and you get fooled, and you definitely don't want to buy a second time unless things have changed. Well, maybe things are starting to change. And a number that GM turned out with these earnings, 60% increase in second quarter profits. That's just fantastic. They also took up their guidance for full year. They took up their guidance for their full year profitability. So fantastic earnings. Stock pre-market, before the market opened, was trading higher. And then what happened? Well, by the end of the day, the stock was down 6% yesterday. Today, before we came on the air, GM was down again, another 1.5% or so. So market's just not excited about GM right now for whatever reason. I have a chart here on GM, and perhaps this chart may say it all, right? GM, General Motors, China business, and annual income and market share. So you can see here, back in 2012, the annual income and market share of GM in China, the second largest economy in the world, obviously behind the United States. But you can see here how the equity income in China and their dominance or market share has gotten lower and lower and lower each year. And so far this year, nothing has really changed to stop that. So maybe the market's just not happy about GM's market share in China, GM's growth in that area. And so maybe that's what investors are leaning on, because in the past, China has been a big part of GM's growth story. And wanted to, before I leave the GM story, I want to show a chart of GM. And this is actually a fantastic chart showing how well the stock has done. Trading, well, let's say at the end of last year, under $30 a share. As of yesterday, it was trading in and around $46 a share. A huge, huge return for a name like GM. Much better than some of its competitors like Ford, for example. I think it's done a lot better. Their dividend was a lot higher once upon a time. Today, it's only about 1% dividend. So perhaps a dividend increase is in the cards down the road, but we'll have to see. So GM, great earnings, but disappointing in terms of their stock market action. Getting to some of the bigger names, two of the Mag 7, Magnificent Seven. I know in our interview with Patty and John alluded to the Mag 7 many times. The seven biggest tech stocks really in the world today, if you count Tesla. I don't know if Tesla would be in the top 7 as largest in terms of market cap, but definitely a powerhouse in the tech space. But Alphabet reported earnings after the bell yesterday, and I thought Alphabet earnings were pretty good. Alphabet, for those that may remember, we're talking about Google. Google changed its name to Alphabet a little while ago now, and I thought their earnings were good. They reported their first quarter of over $10 billion worth of growth in the cloud business. So their cloud business definitely gaining speed, gaining momentum, gaining or catching up to Azure or Microsoft's cloud business. Also trying to catch up to AWS, Amazon, which is the biggest cloud business. So their cloud was great. Their search, it's interesting because search has been the part of their business that many have been questioning, saying that with artificial intelligence and what Microsoft is doing and many others, that Google search would be affected negatively by AI. Hasn't happened yet. Google is doing really, really well. Where they came a little bit soft and fell a little bit short was in their YouTube. YouTube numbers were a little short, a little soft. They were light on revenue with respect to YouTube. But many people said, okay, we can live with a slightly less number on YouTube. But if their cloud, if their search is doing really well, online ads are doing well, then they can live with that. And a chart here we have on Alphabet, quarterly revenues. You can see that really since the end of 2022, it's been on a nice trajectory upward. The stock has definitely benefited from this. We have a chart of Alphabet here. The next chart we can put up is a chart on Alphabet. And look how well the stock has done. I think there are a lot more room to run. Alphabet trades at around 22 times forward earnings. However, when you have a growth rate in the high 20% range, a 22% growth rate, or earnings per share PEG ratio is really good. I think a name like Alphabet or Google looks good at 22 times, growing at almost, let's say, high 20%, almost 30%. So Google's a name that, I've mentioned on this show before and like. Third name that I wanted to touch on with respect to quarterly earnings is Tesla. And Tesla came out as well yesterday, a mixed bag. They actually grew quite a bit, grew revenues on the top line. You have here their quarterly revenues by segment. You can see here total automotive revenues is the dark blue, services is the light gray, and the yellow is energy. They do energy generation and storage with their batteries, etc. So you can see how much of their business is still automotive, of course. But Tesla top line growth was good, beat expectations, but bottom line was the weakness. And that just tells everybody that obviously their margins are being squeezed a little bit with competition coming, especially from China. We're seeing an increase in costs as well. Tesla is facing that, and also overall sales. It doesn't look like Tesla is going to meet their annual numbers for overall sales this year. They haven't taken those down yet, but reading between the lines, I think it's going to be very difficult for them to sell as many Teslas as they did in the year prior and prior years. So Tesla, a bit of a mixed bag. Stock is down actually quite a bit on a disappointing number. And I think actually one more thing I will add, they talked about their robo-taxis. We were supposed to get an announcement on robo-taxis in August. They pushed that off until October now. And I think that also has affected the Tesla stock to the negative side. We have a chart on Tesla. Let's put that up. You can see how well Tesla stock has done with the talk about robo-taxis. And they also came in the last little bit showing how many cars that they've sold and they're building. And that got a bit of a spark. The stock actually at one point got back up to about $800 billion of market cap and has since unfortunately pulled off. You see today, 7.5% downward from where it was almost 250 a share. So those are the three stocks that I wanted to outline today. Next week, we have a lot of the other big cap tech names, Microsoft, Amazon, Meta, formerly Facebook, just to name a few big tech names. Qualcomm is another one, big chip maker. AMD, another big chip maker. So we'll be waiting to see what those names tell us. Second point I wanted to touch on, economic data. And as I mentioned, PCE and GDP. So these are two things that we're all going to be watching. PCE, price, personal consumption and expenditures in the US, a measurement of inflation. How does PCE look? Our first chart shows us here that it shows PCE coming down substantially. Now PCE somewhere in the 2.7 range, 2.6 range, and really a good number for the Fed, and a number that I think the Fed wants to continue to see moving towards 2%. Our next chart after that we have is GDP, and you can see GDP for the second quarter that will come out. Our first quarter, 1.4% in the US, obviously down from where it was in the last quarter of last year, 3.4%. So definitely a deceleration, something the Fed needs to watch, and they'll be watching that. So economic data, PCE, GDP, two things that I think everybody should be looking at. Third point I wanted to mention before individual investors, I guess, make their investment decisions. And this is this idea of overweighting a position or a sector in your portfolio. And, I know everybody likes to have a balanced portfolio. To me, that is extremely important as well. But there are times when you feel strongly about an investment or maybe even a sector. And obviously, over the last couple of years, that sector that I'm sure most have felt strongly about has been tech. So is it wrong to overweight a name in tech? Is it wrong to overweight a position in a portfolio in any sector? And what I mean by overweight is, there's market weight, what the market has in terms of its buildup of its index versus what you have in terms of the buildup of your portfolio. And so for me, some of the names that I have considered and I have taken on an overweight position in portfolios, some of the names I wanted to show you today. First one is Amazon. We've spoken about this stock. Amazon has done extremely well, although lately it's come down from about $200 a share. The recent pullback in the tech space in the markets, Amazon has pulled back as well. But nonetheless, it's been on a terrific run. And Amazon is a name that I think going forward, if you can handle the volatility that the name brings to a portfolio, it's a name that I think you can consider overweighting a little bit. And I think that will give you some good growth. Again, volatile, but some good growth. Another name that I wanted to bring or show us today, Advanced Micro Devices. And we have a chart on that as well. You can see here, AMD, a bit of a different chart since it hit its high, I guess, back mid-March, $227 a share. It's pulled back. Today, somewhere around $150 a share. Not sure what it's doing this afternoon as yet. But overall, it's a name that I think you could consider getting behind and perhaps overweight a little bit, because it is a name that I think has a lot of promise. New chips coming out, that's the rumor, in the fourth quarter of this year. The company is just unbelievable, well off its 52-week high. So you're probably getting in possibly at a nice discount if you look at it today or sometime in the near future. And I think AMD, great management, Lisa Su, great CEO. This is a name that I think individual investors may want to overweight, or perhaps overweight the chip space in general. A lot of great chip names. And of course, AMD, NVIDIA, Qualcomm, and many others are in that space, and you may want to overweight that position. The last name I have here, which is a name that hasn't worked out as well for me, and I know for some of my investors that may be watching today, they've heard me talk about this many times, and that's Bank of Nova Scotia. I think Bank of Nova Scotia has been a great stock to want to buy, to own, but the shares unfortunately haven't really, share price hasn't worked out in my favor too much over the last little while, but it pays a fantastic dividend, 6-7% dividend, while you wait for these shares to finally start to move higher, for Scotiabank to get its act together, to start moving higher. And banks in general, I know a lot of people like to overweight the Canadian bank stocks, because living here in Canada, it is our biggest sector, and it is probably the most important one. So overweighting Canadian bank stocks or overweighting certain positions like Scotiabank versus another bank, I think can make sense for individual investors.